Greetings everybody. Makadizwe new Salibonani. Okay, welcome to my video edition where I'll be discussing a couple of questions from the May-June session for 2002. I think to be more specific, I'll be looking at question number 1 to 10 in order to keep the videos short, and I'll go ahead and do that for a couple of papers, looking at question number 1 to 10 so that we look at common things at once. So without wasting much of time, let's look at the questions contained in the paper. Right, question number 1. What is the accounting equation for capital employed? There are different ways of calculating capital employed, and I think this is one opportunity that we have to refresh our memory on how working capital is capital employed is calculated. So I'm going to show the ways in which capital employed is calculated, and then we pick the correct alternative. So capital employed is equals to equity plus non-current liabilities, right? It is also calculated by the missing figures from our statement of financial position. Remember, the statement of financial position is made up of non-current assets, and current liabilities, right? So here we've just taken the part of equity and non-current liabilities, meaning to say the other elements make up capital employed as well. So I would say that's total of assets minus current liabilities, right? This formula can also be written as follows. Non-current assets or else fixed assets plus current assets minus current liabilities, right? Meaning to say this total assets is replaced by this non-current assets plus current assets will obviously give me total assets, right? Or else we can write this formula as non-current assets plus working capital being current assets minus current liabilities, right? So these are the formulas. So we go back to our question and look at the correct answers there. right? In fact, the correct answer, right? What is the accounting equation for capital employed? Current assets less current liabilities, that is working capital, so it's not the answer that we're looking for. Fixed assets plus current assets minus current liabilities. We can match this to that. Right, that's capital employed. Non-current assets plus current assets minus current liabilities. So the answer that we're looking for is found at B. Let's just look at the other alternatives available. Fixed assets plus current liabilities. There is the madness on this alternative. The net assets minus current liabilities. It means current liabilities would have been deducted more than once. Why? Because net assets is the difference between total assets and total liabilities. So we move on. I think on that question we are done. All right, question number 2. When preparing a sole trader's annual accounts, no adjustments were made for closing amounts prepaid. Right. What is the effect of these omissions? No adjustment was made. No adjustment was made. Meaning to say the income statement or the figure that was transferred to the income statement did not deduct the prepayment. Remember, the prepayment would relate to a future accounting period. So if no adjustment is made, it would mean that our expenses would be overstated, and an overstatement of profit, an overstatement of expenses would eventually result in understatement of profit. But also, if no adjustment is made, it would mean that the figure is not reflected in current assets. If it is not reflected in current assets, the current assets will be understated, and the eventual owner's capital that is calculated as assets minus liabilities will also be understated. So we look at the alternatives. Net profit overstated, creditors understated, right? That's wrong. Net profit will be understated. Then there is no relationship with creditors. So we cannot take alternative A. Then let's look at alternative B. Net profit understated, that's true, but there is no relationship with creditors. So we move on to C. Current assets overstated, that's a lie, because the prepayment would not have been included. Owner's capital overstated, that's a lie. We need the opposite of this, right? So current assets understated, yes, that's true. Owner's capital understated, so the correct answer would become D, right? Then we move ahead. Look at question number 3. Which item is revenue expenditure? Remember, revenue expenditure is money that is spent in the normal course of trading, that is in the day-to-day running of the business, including amounts that are incurred in maintaining the current earning capacity of non-current assets. So we look at the amounts there to find what conforms to our definition, right? Cost of painting new office premises. I think that's a cost of bringing an asset to a working condition or to its intended condition. So that can never be revenue expenditure. Cost of repairs to factory plant and machinery. That's a cost of maintaining the current earning capacity of a non-current asset. So this qualifies to be revenue expenditure. I'm sure all the other alternatives, C and D, represents capital expenditure, right? So like C, legal fees for purchase of new factory premises that are associated with the acquisition of a non-current asset. Therefore, they are supposed to be capitalized. They are capital expenditure. Then wages of a company's own workmen for building an office extension. They are adding value to an existing non-current asset. So that is capital expenditure, right? Then question number 4. In the cash book of a company, the bank account showed a credit balance of 5,000. Credit balance in the cash book would mean that there is an overdraft. So that's an overdraft, right? Then there were unpresented checks amounting to 1,500, fair and fine. Then the statement, the bank statement showed bank charges of 700, not in the cash book. So we know the procedure for doing bank reconciliations. We start by updating our cash book. After updating the cash book, then we do the reconciliation. So I'll go to my working area and do that, right? So I'll start with an updated cash book. Right, start off with the balance BD. Like what we have noted, the balance is an overdraft, and an overdraft will have a credit balance. So balance brought down 5,000. Then from the facts of the question, we are told that there are bank charges on the bank statement which are not yet entered, and bank charges are a payment, therefore they are supposed to be entered on the credit side. So we come and put our bank charges 700. We are done with updating our cash book, so we balance it off. Simple math there, 5,700, 5,700. Balance carried down, 5,700. Carries of our time, I'm not going to write the balance brought down there. So we are going to look at the reconciliation statement. I'm not going to write that, I will just dive into the reconciliation statement. So this is an overdraft. So overdraft as per cash book 5,700. Then if I start with an overdraft as per cash book, I would have to add bank lodgements or deposits not yet credited, of which the question does not contain them, right? So I have to deduct unpresented checks. So less unpresented checks, and the question is saying they amount to, these amount to 1,500. So less 1,500 we get 4,200. Overdraft as per bank statement. Right, fair and fine. That's the answer that we're looking for, but this one will be having a credit balance in the cash book. But remember, they have opposing effects. If there is a credit balance on the cash book, then on the bank statement there will be a debit balance. So we look at our answers to find the correct alternative. Alright, so 4,200 debit or credit. It's 4,200 debit, like what we have identified. Right, so next to that, question number 5. A business increased its provision for doubtful debts by 1,600. What would be the effect of this adjustment on the final accounts? So to my mind, you just need to show the double entry. Which account is supposed to be credited? Which one is supposed to be debited? We debit our income statement, or else the profit and loss, and we credit our provision for doubtful debts. So debiting income statement would mean that we are decreasing profit, right? Crediting provision for doubtful debts, the provision for doubtful debts will be increasing, and this amount will eventually be deducted from the trade receivables figure. So the correct answer is that we will be decreasing the profit because we've debited the income statement as well. We'll be decreasing our debtors because the provision for doubtful debts would have increased. So the correct answer there is at A, where we decrease net profit by 1,600 and decrease our net debtors by 1,600. Then let's look at question number 6. Question number 6. Right. What will always be classified in the balance sheet as a current liability, right? We'll look at each and every item there, and then we will see which one is supposed to qualify to be classified as a current liability. Debentures. Debentures will be a non-current liability unless their maturity date is within 12 months. So ordinarily they are a non-current liability. Then preference shares. It depends on whether the preference shares are redeemable or non-redeemable. If they are redeemable, they are treated as a non-current liability, and if they are non-redeemable, they are treated as part of equity. Prepaid expense is a current asset. Proposed dividend, right? Remember, I highlighted that this paper was set quite a long time ago, so some of the things contained here will conflict with the recent treatment. Proposed dividend is what we are going to check, but I'll make a comment on that, right? Proposed dividend under current accounting standards, is specifically International Accounting Standard number 10, is not supposed to be entered in the statement of financial position nor the statement of changes in equity. So in other words, we don't recognize it in the statement of changes in equity and the statement of financial position. Rather, we disclose it as a note to the financial statements. But at the time when this paper was set, it was correct to treat proposed dividend as a current liability, right? So it is the correct answer according to this question. But if it comes in recent times, we know that it is supposed to be disclosed as a note and not recognized in the financial statements. Right, then next to that, there is great uncertainty about the continuance of a business. This has caused the proprietor to make a large reduction in the valuation of year-end stock. Which accounting concept does this illustrate? Right, I will know from the statement that this is an indication of the underlying assumption for the preparation and presentation of financial statements, which is going concern. Whenever we are preparing financial statements, it is assumed that the business is going to continue into the foreseeable future. And if the business intend to close down or to materially curtail some of its operations, then we are going to state the assets at their breakup values. So here there is uncertainty about the continuance of the business. Therefore, they have decided to show the assets at their breakup values. This is done in line with the going concern concept. Right, so this is the underlying assumption for the preparation of accounts, that is going concern. We know pretty well that matching concept deals with the recognition of events and transactions in the period to which they relate. Materiality is about how important amounts are in terms of their treatment and presentation. Right, substance over form states that we take the commercial reality of a transaction instead of its strict legal form. So for assets acquired on hire purchase, for those assets acquired on lease agreements, they are going to be recognized in the financial statements as if we own them, because the commercial reality of that transaction is that we are benefiting from them. We are gaining some economic benefits, though we don't own them, but we take the commercial reality of the transactions instead of their strict legal form. So we go to question number 8. The table shows information from the books of a business at 30 April 2002. Right, invoiced. Credit sales invoiced during the year. Goods sent to a customer on 28 April 2002 and invoiced for May 2002. The actual transaction took place on 28 April 2002, though the invoice was sent. So I hope and believe that it is apparent from the facts that were given that this is a sale for 30 April 2002 or for the year ended 30 April 2002, despite the fact that the invoice was sent on 4 May. Then goods sent to a customer during April 2002 on a sale or return basis, but not sold by 30 April. So those are not supposed to be treated as sales or revenue. Right, so what is the question saying? What is the amount to be credited to the profit and loss as sales for the year ended 30 April 2002? Right, so from the facts given, 79,000 is a sale, 6,100 is a sale, but 8,300 is not a sale because no indication of retaining the goods has been indicated by the customer of those goods. So we are going to add the first two, 79,000 plus 6,100. I'm sure we get something like 85,100. So the correct answer there is at B. Right. Let's look at the last two questions. Right. Question number 9. The following items are, the balance on the sales ledger control account is 40,000. The following items are then discovered. Total sales day book had been understated, right? So it's not included in that amount, so we have to add it, right? Discount allowed not entered in the sales ledger control, so it means it's omitted from that figure, and discounts allowed will have to be deducted from the amount that we are given there. Then bad debts written off, not recorded in the sales ledger control account. Yes, they also have the effect of reducing that amount. So then the question goes ahead to tell us about provision for doubtful debts, but provision for doubtful debts are not supposed to be entered in the control account. So what we'll have to do, we take 40,000 plus 500 minus 1.2 minus 400. We get something like 38,900. That would be the correct alternative. Right, then the final question on this session. The trial balance of a business does not agree. The difference has been entered in a suspense account. The error was caused by a check of 400 from OMA. From OMA, it means OMA is the one who is giving. Remember, double entries test that debit the receiving account and credit the giving account. So but it was debited to OMA's account, meaning to say we have debited OMA instead of crediting OMA. So every effort of correcting this error will first have to multiply 400 by 2 because the amount is existing on the wrong side, and we put it on the side where it belongs. So we are going to credit OMA's account. But because this is one of the errors that will cause a suspense, we are going to eliminate the suspense that was created by this error. So obviously, it cannot. The answer cannot be A, cannot be B. Why? Because the amount had not been doubled there, right? So the amounts that are doubled are appearing on C and D. But what conforms to what we have discussed is there at C. So the correct answer is at C. Right. Thank you. Let's meet again in another video edition.